Hi, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this BCI podcast number 35, titled Covered Call Writing with a Biotech Company. A real-life example with Argenx, which trades on the NASDAQ exchange under the ticker symbol ARGX. One of the most common mistakes made by covered call writers and put sellers is that an underlying security will be selected because it generates the highest option premiums. Now, this can certainly be enticing, but doesn't really make sense. Covered call writing and put selling are conservative option strategies. Does it make sense to take a volatile underlying stock in these conservative strategies? So let's examine. Okay, so first let's talk about biotech companies and covered call premiums. Now, because biotech companies are generally volatile, and that's because they depend on the success of their pharmaceuticals. So if they happen to have a very successful pharmaceutical, or there's a favorable FDA approval regarding one of their products, price of that stock can go skyrocketing. On the other hand, if an approval is disappointing or lack thereof, then the price of the underlying stock can go down. So there are a lot of things that can happen news-wise that can affect the price of these biotech companies. Therefore, the implied volatility of these stocks are very high. That means that the market's anticipated movement of these securities, either up or down, is quite high. So it can go up a lot or down a lot. One thing about implied volatility, it doesn't give us any information on direction. It just tells us that the expected price movement over the next year is expected to be either high or low or average. Now, one of the things that's positive about this for option sellers is that high implied volatility securities will generate much juicier premiums. So there's a sense that maybe these are the underlying stocks that we should use because we're getting back such large premiums. But I would suggest that you take a deep breath and have a look at the other side of the equation, and that's the risk to the downside. So just like a stock can go up a lot if it has a high implied volatility, it can also go down quite a bit as well. So we have to be careful. Now, if we took a look at a price chart of Argenx from 2018 through 2019, March through March of those years, you would see that there's whipsawing in price all over the place. It goes up a lot, it goes down a lot, it goes up again, it goes down again. Huge whipsaws in both directions. Now, over the course of that year, the price of this stock more than doubled from about 50 to 120. So if you took an overview of the price movement of Argenx, you would see that it was very favorable. But yet, within that year, there were times when the price declined dramatically. Like, for example, in September of 2018, the price went from about 95 down to about 55. Imagine if you held the stock during that time frame. You'd be miserable. So this is something that we need to factor in when we're deciding which underlying securities should we select for our option selling strategies. And what I'm here to tell you is that that decision should not be based on option premium. So looking at that particular chart, we see that the volatility or that whipsawing explains why the option premiums were nearly 8% per month for near the money strikes. That's extremely high. That's 72% and 96% rather annualized. Very high. And we have to understand that in addition to those very, very high risks, we're susceptible to downside risk. Do we want to take that? Covered call writing and put selling are conservative strategies for conservative investors who have capital preservation in mind. Is this an appropriate stock for your portfolio. Only you can make that decision. Furthermore, because there's such a possibility that the price can go up significantly, we may be faced with rolling decisions pretty frequently if the strike ends up in the money as expiration is approaching. So that's something else we're going to have to deal with. So how do we do this? How do we know whether a stock is too volatile or just perfect? Well, again, one size does not fit all. Here's how I do it. If you set an initial time value return goal range for 1 month near the money strikes, now you can adjust that. I mean, maybe you do weeklies, maybe you do longer term. My sweet spot are monthly options. So for 1 month near the money strikes, in the money or out of the money, I want to see a 2% to 4% initial time value return per month. In a very, very strong bull market, I'll go up to 6%, but never higher. Now, these decisions are based on what my goals are, how much money I'm looking to make, and personal risk tolerance. So the lower the risk tolerance that you have, the lower the returns you try to generate, because the higher return are generated by more volatile underlying securities. So you have to make that decision ahead of time. For me, 2 to 4% a month for near the money strikes will keep me within the type of risk that I'm willing to take for my option selling portfolios. Now, what about rolling decisions? Let's say your strike is in fact in the money as expiration is approaching, Thursday or Friday of expiration week. Remember, Friday at 4 p.m. Eastern time. After that, we can't do anything at all about our trades. Well, number one, are we still bullish on the underlying stock? Probably yes, if the strike is in the money. That means that it is higher than the strike price that we sold. So chances are it is, but you have to make sure of that. Make sure that the calculations for rolling the option meet our established goal. I told you before, 2 to 4% for me. So when you take the premium for rolling the option to the next month, either out or out and up, and subtract the premium that it cost you to close, will that net gain meet your strategy goal initiative? So we have to make sure that the amount of money that we're bringing in meets what we're targeting. Once again, we have to make sure that our personal risk tolerance aligns with the danger of the trade. But again, if we were in that trade to begin with, and now we're looking to roll the option, chances are we've already made that decision. And finally, we have to make sure that the month we're rolling into has no upcoming earnings report. One of the golden rules of the BCI strategy is to never sell an option if there's an upcoming earnings report. So those are the factors that will dictate whether or not we're going to roll an option if the high implied volatility of these companies like biotech companies cause the strike to end up in the money as expiration is approaching. So let's summarize now. Stock selection should be based on fundamental, technical, and common sense analysis, not based on option premium. Please, that's very important. Too many people will be enticed to purchase a very, very volatile, risky stock because of that premium. Don't let that happen to you. The implied volatility must align with your or our trading goals and personal risk tolerance. It varies from investor to investor. There's no right or wrong here. Generally speaking, volatile stocks are not appropriate for conservative option selling strategies. Now again, that will vary from investor to investor, but I'm here to tell you that covered call writing and put selling are conservative strategies for conservative investors. Now, the Ellman calculator will assist with these trade decisions. You could use the What Now tab to look at the rolling decisions and also the multiple tab to look at the return on the near the month option. And that will let you know whether or not it meets your stated strategy initial time value return goal range. Now, I know many of you already have the Elman calculator, but for those of you who do not, you can go to my website, www.thebluecollarinvestor.com. Look at the black bar on the top of the web pages and click on the link that says free resources, including the Elman calculator, and you can download it right to your device, along with its user guide and several other free resources on our website. In our store, thebluecollarinvestor.com/store, we have multiplicity of online video programs, DVDs, ebooks, soft and hardcover books, calculators, spreadsheets, trade planners, and so much more to help elevate your returns to the highest possible levels. So that ends our BCI podcast number 35, covered call writing with a biotech company, and we used a real-life example with Argenx. And so, ladies and gentlemen, I hope you enjoyed this podcast, and most importantly, I hope you benefit from it. As always, this is Alan Elman, the Blue Collar Investor. Take care, everybody.